Hi, Tiffany Woodfield here. I'm going to talk about Roth IRAs and what to do if you're living in Canada and have a Roth IRA, or if you're planning a move to Canada. I'm going to go over some of the most common mistakes that people make when they have a Roth IRA, and also how to do a backdoor Roth IRA and see if this might be an option for you. And if you need help right away, go to our website and download our guide on financial planning for US citizens living in Canada. It's at swanwealthcoaching.com. As a cross-border financial advisor, I've talked to countless people who are moving across the border and they don't know what to do with their Roth IRA once they come to Canada. So let's get into it. The first thing you need to know is when you become a Canadian resident, you have to make sure you do not contribute to your Roth IRA, otherwise it will taint the Roth. What this means is it will lose the tax-free status for Canadian purposes. Also, if you contribute to a Roth IRA, it becomes an accounting nightmare. This is because as a Canadian resident, you won't be getting the correct tax slips, and this means you'll be paying more to your accountant at tax time. Once you're living in Canada, you'll have to file a one-time election for each Roth IRA account. What an election is you're electing to have an alternative tax treatment for each account. For a Roth IRA, what this means is that you're electing to have it treated like a pension according to the Canada and US tax treaty. This means that you can defer the tax in Canada. In terms of timing, you will have to file the one-time election with the CRA by April 30th of the year after you became a Canadian tax resident. Next, when dealing with a Roth IRA in Canada, you might be considering doing a backdoor Roth. This would be something you would do before you move to Canada. But why would you bother doing this? The reason you might consider this is if you're moving to an area with a higher tax bracket, such as Canada. Because withdrawals from a Roth IRA, if they're qualified, are generally tax-free. Also, with a Roth IRA, you aren't required to take required minimum distributions, and you can take out tax-free income in retirement, as opposed to an IRA where you'd be taking taxable income. In addition, if you have a large amount in an IRA, your required minimum distribution will be higher, which could push you into a higher tax bracket in the future. Instead, if you have a Roth IRA and a regular IRA, it gives you flexibility with your financial planning in retirement. What I'm going to go over now is how to create a backdoor Roth. First, you fund a traditional IRA with before tax money. This could also be a conversion from a 401k to a traditional IRA. Second, you convert a portion of your traditional IRA into a Roth IRA, knowing that whatever you convert comes into taxable income. Now, when I say convert, what I mean is you're moving money from your IRA into your Roth IRA, and knowing that that money is taxable. Also keep in mind the rules around moving the money. You can have it with an existing Roth IRA or open a new Roth IRA account, and let me go over the 3 ways that you can move that money. You can do a 60-day indirect rollover. What this means is you would go to your financial institution and get a check from your IRA and transfer this money and deposit it into your Roth IRA within 60 days. Keep in mind that if you don't get that money in within 60 days, it becomes taxable income. You can also do a direct transfer at the same financial institution. So you would move your funds from your IRA to your Roth IRA at the same financial institution. Or you can do a direct transfer from one financial institution to another. What this means is if you have your IRA at one financial institution, you can then have that rolled over to a Roth IRA with another financial institution. Let me give you a simple example. Let's say you have $1 million in an IRA and you wanted to convert $200,000 into a Roth IRA. In that year you did the conversion, it would be like you earned an extra $200,000. That means that would be taxed at your graduated tax rates. Because whatever you convert from an IRA into a Roth IRA comes into taxable income, you may want to stretch this out over a couple of years. And remember, you don't want to do a backdoor Roth once you're a Canadian tax resident. This is because you would have to now report it to the Canadian Revenue Agency as well as the IRS. Next, let's talk about how to take money out of your Roth IRA while you're living in Canada. First, make sure you follow the rules that I've mentioned earlier. Then, make sure that you follow the rules that are outlined by the IRS to have it deemed as a qualified withdrawal. These rules are relatively simple. You have to be age 59 and a half and have held the Roth IRA account for at least 5 years. Sometimes in instances in Canada, you may have to hold that amount for 5 years with that same financial institution. I recommend you speak to a cross-border accountant before you take any money out of your Roth IRA because it will help you prevent a surprise tax hit. Can a Canadian resident hold an IRA? Now, the reason you might be asking this is one of two scenarios. Either you worked in the US and contributed to an IRA and now are back living in Canada, or you've inherited an IRA. In both situations, you can have this while you're a Canadian resident. The thing that you might find complicated is that you can't find somebody who can actively manage your IRA while you're a Canadian tax resident. In this case, it would be best to work with a cross-border financial advisor. They can provide advice and solutions for your assets that are in Canada as well as the US. Finally, if you have a Roth IRA and you're planning to move to Canada or already living in Canada, I suggest you go to Swan Wealth Coaching and schedule a call with one of our cross-border experts. Thank you for watching, and we'll see you in the next video.